Hi everyone, Jeff Yasteen here. Make sure to subscribe to our YouTube channel, follow me on Facebook and on Twitter, and pass this video along to your friends if you like what I'm saying here. So you know what the biggest news was last week? It wasn't the stock market per se, it wasn't the presidential election, it wasn't about COVID-19, but it was earth-shattering stuff in a way. And the headlines about it barely lasted a 12-hour news cycle, yet it's going to have huge repercussions for two of the world's largest, most profitable companies, and it's going to have even larger repercussions come the end of the year holidays and beyond. So I am talking about Microsoft and its decision to buy ZeniMax Media, which is the parent company of a video game publisher, Bethesda Softworks. The deal was for $7.5 billion. And as the news reports on this deal pointed out, Bethesda publishes some of the most popular video game franchises around, including Elder Scrolls, Fallout, Doom, Dishonored. So the question though is, if you're not a gamer, why should you care? Well, because there's money to be made one way or the other on this news, in my opinion. So just in the US alone, the gaming industry is a $66 billion market. If you add in what gamers all over the world spend each year, and it's about a $200 billion market. Now the stakes are even bigger this year because as we head into the holidays, both Sony and Microsoft are rolling out new versions of their gaming consoles, PlayStation and Xbox. On top of that, Google and Amazon are getting into this space as well. When you buy a new console, you want the latest, greatest games to go with it. And having been a former financial reporter, I can tell you my view on how Sony executives are going to react to Microsoft's action. They're thinking, if Microsoft is buying Bethesda Softworks, then maybe we should be buying a video game publisher too. Now, many game publishers develop games for both companies' consoles. Other titles, though, are exclusive to one system or the other. The main publicly held game publishers are Activision Blizzard, ATVI, Take-Two Interactive, that's TTWO, and Electronic Arts, EA. There are also two Europe-based companies, Ubisoft, which is based out of France, and CD Projekt, which is based in Poland. So more on all those in a moment. Some of the gaming industry don't think we're going to see an acquisition spree from one or many of these companies. I disagree. Now, I've seen many examples of this over the years. When Universal acquired the rights to the Harry Potter books for a new mini theme park in Orlando, what did Disney do? They went out and bought the Star Wars franchise from George Lucas so that they could do the same. A handful of years ago, Amazon bought a company that made warehouse robots. And soon every large retailer from Walmart to Target were also buying their own warehouse robot companies so that they could match Amazon's technological advantage. And on it goes. At the big company level, acquisitions are sort of an arms race. If your competitor makes a big deal, it often compels you to make a deal as well. Otherwise, you're losing ground and the competitive pressures just keep growing from there. So I think that's what we're going to see in the gaming industry within the next year or two, and possibly a lot sooner. While Sony has a highly regarded stable of games for its Xbox system, it needs to make an acquisition of its own or be at risk of losing ground to Microsoft. Not just that, but video games are drawing a lot of attention from Google and Amazon as well. Google's does not have a hardware console, of course, but earlier this year they rolled out Stadia, which is a streaming game service. Sometimes they call it a gaming cloud that's tuned up so you can play console-type games without a console. But Stadia has suffered from technical glitches and, more importantly, also a lack of compelling games, compelling titles to play. And without that, not only do you not get customers, but game developers are not interested in creating compelling new titles for your system either. And last week, Amazon made an interesting move as well. It has a new game streaming service called Luna and announced a partnership with Ubisoft, based in France. And Ubisoft makes some popular games as well, including the shooter game Tom Clancy's Rainbow Siege 6. So how do you make money off of all this? Well, I think any of the major US-based game publishers are great bets here. Whether Sony, Google, or Amazon make a move to buy them or not. But out of all of them, the one I like the most is Electronic Arts. The reason why has less to do with the particulars of the games they offer, and they have some very strong titles, but also Electronic Arts' financial picture and its stock valuation level. Wall Street analysts expect Electronic Arts to earn about $5.51 a share this year, rising to $5.90 next year and $6.80 a share in 2022. So it's going to grow its profits by around 24% over the next 2 years. Now, that is good growth, but it's not spectacular. It's better than what they expect out of Activision Blizzard, but not as good as Take-Two Interactive, where profits could grow by 50% in the same time frame. But Electronic Arts is something else that you should care about: better profitability. One way to measure that is to look at a company's gross profit margins. In a nutshell, gross margin shows us the percentage of money a company gets to keep after each sale once it pays its marketing and its manufacturing costs. So basically, the more cash it gets to retain after all of that, the more cash it has for other uses, like reinvesting back into the business, or paying a dividend if they want to do that, or buying back stock, or making an acquisition of their own. And as you can see from this graphic, Electronic Arts has gross margins of 75%, which is far better than its other U.S. competitors. Another way to look at profitability is with a measurement called return on equity, or ROE for short. That shows us how efficient, how smart a company is in the use of its shareholders' cash. It's the same as if I owned a dry cleaning business or a fruit stand and you gave me money to start my business, so you're my investor. After it gets going, you would want to know if I'm keeping my operating costs low. Presuming I have some profits, am I reinvesting those profits in a smart way so I can make even more profits down the road? So it's no surprise that companies with good returns on equity tend to be strong stocks as well. And when those companies happen to get a buyout offer, they tend to get bought out at a nice premium to the stock price. Now, Electronic Arts case, this is based on data from Standard & Poor's, a buyout of the company could fetch a price of as much as $600 a share. Now, the great thing is, I think we'll be well rewarded either way for owning the stock. In Electronic Arts case, analysts expect the company to earn about $6.80 a share by 2022. Now, right now, because of worries about the economy, the pandemic, consumer spending, investors are only assigning a price-earnings ratio of 19 to own the stock. That's low. In past years, they've typically assigned a PE ratio of as much as 35 in order to own the stock. And I think we're going to see that kind of multiple again and the stock move higher, as well as many of the other stocks within this industry as competition heats up within this category. So if we take that price-earnings ratio, multiply it by 680 a share in profits in 2022, that gives us a stock price of around $238 a share, which is an 80% gain over what the stock is right now. So it's 80% in 2 years, which isn't too bad at all. And it could be beyond that even if we see the buyouts that I expect from either Sony or Google or Amazon or perhaps even Microsoft in the next quarters to come. If you like what I'm talking about, make sure to follow me on social media, subscribe to us on YouTube. I'm Jeff Yasteen.